Welcome to the Property Voice Podcast, helping you to navigate safely through the world of property investing. Get the lowdown and updates, insights and outcomes on all matters property with a splash of entertainment along the way. The Property Voice, a voice to trust among the crowd. Now, let's get started with your host, Richard Brown.
Hello and welcome to another edition of the Property Voice Podcast. My name is Richard Brown, and as always, it's a pleasure to have you join me again on the show today. So as you probably heard from last week, we're preparing the next series right now, and that will be released soon. But in the meantime, I had a couple of options really. One was to take a break and really just put my feet up, I suppose, or at least plough into the preparation, full time for the next series. And as tempting as that was, I actually thought I'd do something a little bit different instead and really keep momentum going. So you've probably picked up from me by now that I do like different, not necessarily outrageous, just a little different. So what I plan to do over the next few weeks is just share a few of what I call my personal musings. Now, these are topics that have grabbed my attention and have occupied my mind a little bit, and I guess it's going to be a mini series of musings that we'll be sharing over the next few episodes as we prepare ourselves fully for Series 2. So sit back, relax, and join me, just me this week, as I share the first of these musings today. And I'd be very interested to hear your thoughts and indeed your reactions to these as we go through. So without further ado, let's get cracking with Property Chatter.
Okay, so let's get on with this week's featured topic with Property Chatter.
So do you know how sometimes a certain subject seems to be cropping up all over the place? Yeah, I guess it's a bit like choosing to buy a car and you've perhaps singled out one or two on a short list and then you see them everywhere. It's a bit like that, isn't it? Or buses that seem to be delayed and then two or three turn up at the same time. It's these sorts of topics is kind of what I'm referring to today, and I guess you might call it trending in modern day parlance anyway. And so today's topic has probably been trending, in fairness, for quite some time really, and there's been a few events of late which have stimulated me to talk about it on this week's show in the first of what I'm going to call the Property Voice Musings. So as well as this topic being discussed on at least two other property podcasts that I listen to, I can shout out the Property Podcast with the two Robs and the Property Investor Podcast with Anna Harper and Damien Fogg as cases in point. But I also then came across a forum post over at the Property Hub. Yes, that's another incarnation from Rob and Rob. So you guys, you definitely owe me for these shout outs in the show this week. That was all I can say. But going to that forum post, there was a poster by the name of Noel, and he had a bit of a decision that he wanted to make. In fact, he had a dilemma really, because it was whether or not he thought it was, or in fact, if we thought as contributors to his post, it was worthwhile converting his existing home into a rental property. And in doing so, he was planning to remortgage and release funds to invest in an alternative rental property as well. But his main concern was really doing the numbers, which is a good thing, and he's looking at primarily the after-tax ROI, or the after-tax return on investment, on the former home. So let's just share some of the situation that Noel outlined as a bit of context, if you like, because I'm sure not all of you would have seen this post. So just a bit of an outline, if you like. So Noel said his home was currently worth £165,000. and that after the remortgage he would have a loan outstanding of £92,000, obviously secured on the property. And out of that transaction he would be able to release cash for further reinvestment to the tune of £31,000. In addition, the rent was £650 per month, which puts the gross yield modestly at around about 4.7%. And the ROI, or return on investment, that Noel had calculated in his personal case was 7.34% after year 2, because year 1 had some extra costs, but after year 2 is 7.34% gross, and falling to 4.4% after tax. And it should be noted that Noel says he is a higher rate taxpayer. So that was his situation, and his big questions were, what sort of ROI do property investors seek? And indeed, was this deal worth it, given the lower single-digit return figures that he'd obviously outlined and calculated for himself? So I guess, in response, let's start by looking at his ROI question, and I'm using his case as an object lesson, if you like, about this whole topic of your home as an asset, your home as an investment, and indeed, as by doing so, I want to outline some of the tax position that comes into play, which makes it perhaps a different scenario to that of standard buy-to-let properties. So that's what we're looking at right now. So ROI is his first question, is a very personal criteria, and some people would be happy to merely beat the bank, as we call it, and maybe they'd look for something like a 3% or even a 5% return, which would beat bank returns certainly in today's low interest rate environment. However, some other investors would probably look at a higher sort of risk-reward ratio. Consider, for example, a property developer who would probably be looking for 20%, 30%, or possibly even more with a project because of the risks that it carries. So they need to price in some of the risk, if you like, into their overall return in case there's a deal that doesn't go so well. So the first thing really to do is to decide what the right return on investment level is for us personally. And for me personally, it does vary depending on the project. I mentioned development projects there, and there's buy-to-let projects, there's flip projects, there's different projects we can get involved in. There's higher maintenance projects, higher management and maintenance projects like HMOs, for example, where we want a better return as well because we may have higher hands-on management going on. So what I'm trying to say is it does vary by project, but certainly for a long-term buy and hold project, it would need to be double-digit for me. That's my criteria at least. However, it's not necessarily as simple as that in all situations, and indeed in this situation there's a number of different characteristics which would, if it were me, would change my opinion. Indeed, and I might be inclined to accept a lower return for reasons I shall outline throughout the course of this Musings episode. So let's just take ROI though. Let's explore that a little bit more. An ROI, return on investment, usually looks at the income return based on the actual cash invested. I've covered this off in Series 1, definitions of some of the metrics that I use in property investing. And ROI is usually an income return on capital invested. But we should also lose sight of the fact that to take account of the total return on investment with property investing, we really ought to have some, recognition of capital appreciation. So total ROI will include all returns, income and capital returns based on our cash invested. Of course, the tricky part with measuring capital appreciation is that it's a fluctuating figure, obviously, depending on house prices, and it can be, it's a paper number until it's realized. So until we actually sell that property, it can go up, it can go down. But it's good just to keep an eye on that and factor it into the equation. So it's more keep an eye on rather than 100% factor it in. But it could mean, for example, in Noel's case, that he might be able to lift his 7.34% return by factoring in an element of reasonable capital growth assumption, depending on his timelines. Now, Noel also mentions taxation, and usually when looking at a deal, I just tend to look at the pre-tax position, personally speaking, when I'm evaluating a deal. However, if we are prepared to do some digging and to fully understand the tax implications, it can indeed change one deal from another one by changing the context, if you like, and the tax regime that we're looking at. One word of caution here, though, I have to say, is that beware rather of the procrastination trap of just losing ourselves too deeply into taxation. And trust me, we really can lose ourselves in this whole issue of taxation. And that's part of the reason why often I don't look into it too deeply. I have a general principle: if we're paying tax, we're making money. So that's a good thing. Obviously, if we're losing money, that's a bigger problem. So that's just kind of my rule of thumb anyway. But yes, it is worth understanding the tax position at times, but don't get into what I would call the equivalent of a dog chasing its tail, because that won't help us really, because we'll never do anything. Just keep digging and hunting out information. But what I wanted to do really was just outline, if you like, quickly some of the general tax positions of different types of property. Let's call it property investment, because not all of them are strictly property investment. Let's call it that, for a personal investor. I do differentiate that, and I'm not going to be looking at everything. For example, I'm not going to consider inheritance tax for the purposes of this discussion. So I'm going to be focusing primarily on income tax and capital gains tax. Let's just say that for the purpose of this discussion, at least. So I guess we should start where Noel is now, and that's, he has his own home. So anyone who owns their own home, obviously we've got mortgages, but let's ignore that. Anyone who has their own home, any returns they make from selling at a profit would be free of capital gains tax, and there'll be no income tax because there'll be no renting that's taking place, because clearly we're living in the property. Now we'll come on to in a minute a twist where we can rent out that property at least in part and still live there, but for now let's just keep it simple. So in other words, there's no income tax and there's no capital gains tax to make on the growth we achieve through owning a home. But there are other situations that come into play. One of which, of course, is that relying on capital appreciation for making a profit or a gain with our own home is, of course, speculation. It's speculative, and there's no guarantee that that will be realized. If we're selling homes in 2009, we would get a lot less for our money for our property than in 2007 and indeed 2015. Maybe we're back to around about 2007 prices now in some parts of the country, but you get the picture that basically it's a speculative exercise, and it does depend on the timing. But I did want to touch on this idea of rental with our own home, because the HMRC have been quite generous, in fact, and so we're talking about taxation here, and they've come up with something called rent-a-room scheme. And for want of a better description, that's an incentive to encourage people to take in a lodger. So we would still have our home, we'd still live at home, but we'd rent out a room or a maximum 2 rooms, because it changes the nature of the agreement if it gets beyond that, to a lodger. And HMRC has basically said we can earn up to £4,250 per year from taking in a lodger before we pay any tax. So that's another tax benefit that we can keep in mind. And so that can start to turn the home into an investment by taking in a rental income stream during the time that we're living there, rather than just waiting for something to be realized at the end. It's a bit of a twist. But when we talk about investment property, generally speaking, we're not usually talking about our own home. We will talk about assets in a minute, but let's just keep it simple. Investment properties. And the most common investment property is buy-to-let, of course. So that's long-term buy-to-let. So we buy a property with a specific purpose. We won't live there, and we'll let it out to tenants instead. And very simply, the tax position there is that we will pay income tax at our highest rate on the net rental profits, and then we would pay capital gains tax on any gains if we were to subsequently sell that property at a profit. And I'll come on to some of the rules and allowances and this sort of thing with capital gains tax further on in discussion. But very simply, we basically pay income tax and capital gains tax. As a variation, if you like, of a property investment is property trading. So instead of buying and holding property, in this situation, we're specifically buying that property with the clear view that we're going to sell that property on, ideally at a profit. And of course, this buying and selling of the property becomes the business, rather than the rental income being the business of buy-to-let. So this changes actually the way tax is treated. And what it means, in fact, is that the profits on sale are then subject to income tax in this particular scenario, not capital gains tax, as would be the case if we sold a buy-to-let property at a profit. So there's a distinction there, and we're starting to get a picture of how we can maybe use the different tax rules to our advantage, depending on our tax position. But I don't want to get too far ahead of myself there. But as a higher rate taxpayer, just as a point of note here with this property trading example, as a higher rate taxpayer, this would make trading property less attractive because of the paying income tax than if we were rather selling buy-to-let properties at a profit, because we pay a lower rate of capital gains tax than we would income tax. But it does rather explain why a lot of property traders, so people who do this on a regular basis, they do so through company structures. But that's a different topic. I'm not going to go into it too deeply. I just wanted to highlight it at some point here. Now, the difference, if you like, the unique position that Noel is in right now is he has this hybrid, doesn't he? Because he's got his own home, which he's considering renting out as a buy-to-let rental property. And so it's this unique position that we can't recreate very often, because clearly we can't live in more than one home at once. And indeed, the HMRC would start asking a lot of questions if we were hopping from home to home every couple of months, that's for sure. So we can't be looking to do this quite regularly. But the situation from a tax point of view gets very interesting, in fact. Now, I'm going to try and keep it simple. But we, as I mentioned, when we own our own home, there's no capital gains tax to pay. And the reason for that is that it's classed as our primary residence. On our primary residence, we do not pay capital gains tax. And equally, if we have our own home and then subsequently rent it out, we still have private resident relief on the gains that we make whilst we owned and lived in the property as our main home. So that's the tax relief, just the same as if we own our property. However, because we then rent the property out, we get an extra 18 months of ownership thrown into the mix, if you like. So this is a plus. So it's not just the time that we live in the property that becomes tax-free, it's also the last 18 months of ownership. So just a simple example, if we owned it for 5 years, but we lived there as our own home for 3 and then rented it out, actually 4.5 years would be capital gains tax free under that criteria, with only the last 6 months gain being attributable to tax. But it doesn't end there. In fact, it gets better, because there's something called lettings relief, specifically for people who let out what used to be their own home. So lettings relief applies to a relief for the capital gains tax that we would be liable to pay on the time where it wasn't our own home anymore. Indeed, it was the time that it's rented out. And a bit complicated how lettings relief is calculated, because there's a few scenarios, but very simply it could be as much as £40,000 relief against capital gains tax under that particular offset opportunity that the HMRC makes available to us. And it doesn't end there, it gets better still. We also have an annual capital gains tax exemption, which we can offset against any capital gains tax liability that we make on sale. So that's roughly £11,000 per person. So if one person owns a property, that's £11,000. If 2 people own the property, it'd be £22,000. So we can make a £11,000 or £22,000 gain depending on the ownership structure, again without paying any tax on that. So I think you're going to have to agree with me here when I say there's an awful lot of pluses in this quite unique situation, which starts to paint the picture that I'm really trying to paint here, that actually, in many respects, our own home can be used to our advantage. Let's just use that language, because I'm going to come on to the whole issue of asset, whether our home is an asset later on. But certainly from a tax point of view, it's going to be very tax efficient if we convert our own home into a rental property at some point. There we shall see. Now, any rental income that we would receive once we've converted that property from our own home into a rental property, a buy-to-let, would be subject to income tax in just the same way as any standard buy-to-let would. So really the difference here relates to capital gains tax. And I should also point out that capital gains tax has a lower rate of taxation than income tax. So income tax basic rate is 20% and higher rate is 40%. There is a highest rate of 45%, as I'm sure you're aware. But with capital gains tax, basic rate taxpayers would pay 18% capital gains tax, and higher rate taxpayers, so the equivalent of 40% income taxpayers, would pay 28%. So you can see clearly that there's an incentive to pay capital gains tax because it's a lower rate of taxation. So I'm really starting to touch on this idea of tax arbitrage, which I'm not going to explain now, but I just want to make the phrase available in this stage in the podcast. Now, in Noel's particular situation, he's got a distinct advantage, obviously, because this property used to be his own home, or rather still is his own home. So as you know, if we just go and buy a rental property, rent it out, we don't get some of the benefits, and same with trading property, we don't get some of the benefits. And if we of course if we own our own home, we have to wait for any benefits, certainly for some period of time. So it's this whole unique position that it used to be our home, it's now rental property, and potentially we could sell that later on, that creates this this tax efficient opportunity, I'd say. So in Noel's case, he qualified for PPR relief for the time that he lived in the home. Then he would receive this lettings relief that I've mentioned for the time where any gains that were achieved where he rented the property out, and then he would get the annual exemptions on the capital gains tax if he were to sell that property later on at a profit. And of course, I've already highlighted that in his personal case, he'd end up paying 28% tax instead of 40% tax because he's flipped from income tax to capital gains tax in this scenario. So that's quite a big kicker in the first place. But as I mentioned, he's got this lettings relief. Now, there's a number of rules about how this is calculated. In fact, this whole issue of capital gains tax in this scenario, it can be quite complicated in all fairness. So what I decided to do is, rather than just outline in a lot of detail on a podcast where you're listening and maybe trying to think it through or trying to scribble notes or that sort of thing, I've decided to make an extra bonus available. I've created a cheat sheet and a spreadsheet. So a couple of sheets there. The cheat sheet outlines, what the criteria are and a couple of case studies, and the spreadsheet is like a calculator, so that you can plug in some numbers and work out the tax position, if you like, of this very unique position of converting your own home into a rental property. And basically, I'd like to make that available to listeners of the show. And all you need to do is drop me an email, and you can do that right now. podcast@thepropertyvoice.net. With the title Home Taxation Bonus Material, and we'll be happy to send that to you. So that's a bit of a side there. So there we go. So Noel would have the PPR relief, the lettings relief, and indeed the capital gains exemptions. And in fact, there's one other point I really should throw in as we're just being complete, and that's that he can also offset the buying and selling costs and indeed capital improvement costs against the gain before any capital gains tax is calculated. Now, what this means effectively is that, let's say for a couple who jointly own their own home and then subsequently let it out, they can afford to make at least £62,000 worth of profit. And that's by combining the £40,000 worth of lettings relief with the £22,000 worth of annual capital gains tax exemption. So that's quite a sizable profit that people can make without paying any taxation, I would suggest. So this idea of converting your own home into rental property has certainly got some legs as far as I'm concerned. And we shouldn't overlook the fact that the last 18 months of ownership is also tax-free. So this could mean, basically that the whole idea of flipping our own home into rental property is one of the most tax efficient investments we could indeed ever make. But before we move off that topic, let's just consider that in Noel's particular case, if you remember, he was saying that he was also able to release some money for reinvestment. There's £31,000 that he could put down, presumably as a deposit on another rental property. And I think, if I'm right in understanding his figures, his 7.3% pre-tax return was before taking into consideration any returns that he would make on reinvesting that £31,000. So to be fair, to look at the whole situation, that return on investment on the £31,000 should also be brought into the equation. So there's something to consider that people often forget, is they look at a fairly low return on a property that they've perhaps equity released for further investment and don't maybe join the two properties together, or don't look at the ROI on the bit that they've released to reinvest elsewhere. So worth considering in any what I would call go or no go decision, that's for sure. So I guess in summary, my conclusion for Noel in terms of my response to him was that really he could afford to have quite a modest rate of return on what was his former home. Indeed, it could simply wash its face, really, because of all these benefits, these tax benefits that would arise, so that he could maybe sell that property later and not pay any tax on any potential gain. But equally, he'd be able to release funds to invest in additional properties and be able to combine the return on investment, if you like. So I think I actually used the phrase, it seems like a tax-efficient cash cow to me. And I think that's probably my conclusion, that this fairly unique situation of converting your own home into a rental property, it is fairly unique, as I mentioned, but it is a very tax efficient cash cow, and let's just leave it at that for now. However, I do want to just pause for a minute and consider this idea of what I call tax arbitrage. And you might not be familiar with the term arbitrage, but essentially that's what's defined as the simultaneous trading of assets to take advantage of different pricing in different markets. And if you've ever read the book The 4-Hour Workweek from Tim Ferriss, he highlights it very well in this particular book, because he earns his money in the USA. So he earns US dollars in the USA, which obviously is a high economic, wealthy nation. But because he travels quite extensively, his spending is in lower cost economies such as Asia and indeed South America. And he calls this concept in his book geo-arbitrage, so geographic arbitrage, that he spends money in lower cost environments to where he earns money. And I guess in a roundabout way, I'm implying something similar, this tax arbitrage methodology of trading different tax rules and environments, if you like, to arrive at a better overall after-tax result. And that's what I'm calling tax arbitrage. So it's the idea really of switching how an asset is classified and therefore how it's taxed to take advantage of different tax benefits and structures. Here we flip, for example, from, the property trader wouldn't be able to claim capital gains tax. So using your own home as a buy-to-let and then subsequently selling it does allow that to happen. So here's how that tax arbitrage works out. So I really just wanted to touch on that point, that it's all about, maybe looking at individual assets on an individual basis. And this unique position of what was our former home actually is a specialized area and is worth considering. But before I, really, go too far into it, I want to pause as well and just look at the definition of an asset. And this whole discussion about your home is an asset or it's a liability is part of what's topical. And it's what's been referred to in some of the other podcasts that I was referring to elsewhere. And a lot of this controversy, if you like, comes from Robert Kiyosaki and Rich Dad Poor Dad. And most property investors would have heard of Rich Dad Poor Dad if they haven't read it. And, and in fact, I certainly read it and I shout it out all the time. It's one of the books that changed my thinking to a large extent in terms of assets. But in his book, I think it's Rich Dad, defines an asset as something that puts money into your pocket each month, whereas a liability is something that takes money out of your pocket each month. Now, I guess, by Robert Kiyosaki's definition, your own home would never be classed as an asset using that definition, because obviously we're not putting money in our pocket each month. We'd have to wait until we sold that property at a future date and realize any capital gain. But of course, there's no guarantee of that happening, and that's speculation, and therefore Rich Dad Poor Dad would exclude that as being an asset. However, it's not the only definition of asset. The International Accounting Standards Board have got their definition of an asset, and they would know a thing or two about it, I would imagine. And they define an asset as a resource controlled by the entity as a result of past events, from which future economic benefits are expected to flow to the entity. Now, I guess in layman's terms, that would mean if you own your own home and you sell it later on for a profit, then they would class that as an asset. I know it's a business definition, but it's the same point. And so I think you can easily see there that a capital gain on sale of your own property would constitute it being called an asset. So this is where we get this conflict and this controversy arising. I've got my own idea of what an asset is, and I summarize this in my book, The Property Investor Toolkit, and I define it very simply as something that we own of value. And I guess if you apply that definition to our own home, it's got value. It's got to have an increase in value, obviously, for it to produce a return to us. But it's really a question of timing, I would suggest. If we time the sale of our own home correctly with the market cycles, we should end up with a profit. So there we go. So I guess for me, I suppose part of where I'm going with the conclusion is that our home is quite possibly is not only when we convert it to rental property, a unique situation, but it's quite possibly the most tax efficient property investment we could ever make. There's a bold statement. But it does actually require, as I mentioned, turning a home into rental property and then taking advantage of certain tax reliefs such as PPR, capital gains tax, lettings relief, and so on. And there will be a crossover point in time where we've held it for so long as a rental property that ultimately some of those reliefs and those benefits are not quite so great, and we will end up paying some tax eventually. But that's going to take quite some time, I think you can probably understand from that. So as I mentioned, I did a bit of number crunching to illustrate these various scenarios, and I've got this cheat sheet and this spreadsheet, so pop us an email over. It's just reserved for you really as a listener to this show, podcast at thepropertyvoice.net, along with your name and the subject line taxation, own home taxation bonuses, and we'll add you to the list. I'm happy to do that. But maybe just to whet your appetite a little. In Noel's particular case, I'd calculated that he could make something like £129,000 of capital gain. Bear in mind, his property's worth £165,000. This is a simple illustration. I've not looked at his purchase price. But he could make £129,000 of capital gain by converting it to a rental property, selling it in maybe 3.5 years' time, and not pay any capital gains tax at all. And as Paul Daniels used to say, now that's magic. And I'd have to agree, to be quite honest with you. So, Noel could take that $129,000 tax-free lump sum, reinvest it into more properties, or indeed he could do the rinse and repeat methodology, put it into another property and again let that property out later on, etc., etc. So we talked about the tax arbitrage of converting your own home into rental property and utilizing some of these tax benefits, if you like, but I just kind of wanted to really highlight this point that our home can indeed be a very tax efficient asset indeed. So that's what I think, and so I'd really like to know what you think about this idea too. So why don't you get involved? The show notes are going to be over on the website. Drop a comment in there, or drop us a comment on Facebook or Twitter. We'd love to hear from you, or even just an email for a one-to-one conversation. But as far as this episode is concerned, this is the first in what I call my Musings mini-series, so hope you've liked that. It's a bit of a rant or ramble, I suppose. It could go either way. This one's probably a ramble, but I hope you've enjoyed it, and I hope of being able to add some value with some of the thoughts that I've been having on this topic this week. And we'll have another one for you next week for sure. But the show notes, as I say, are on the website. Pop over there and have a look at that, along with further details how to take advantage of this listener bonus. But for now, and until next time on the Property Voice podcast, it's ciao ciao.
Thank you for listening today. Now head over to thepropertyvoice.net for more inspirational content and get updates through our mailing list. Join us next time on the Property Voice podcast. And if you enjoyed the show, please don't forget to rate us on iTunes.